Hi, I'm Tom Elliott, here with another share market update for Beulah Capital. While the Australian economy is bubbling along okay at the moment, unemployment steady at 5.5%, interest rates at all-time lows. I do think, however, that since the Americans announced the end of their quantitative easing or money printing exercise, hasn't ended yet, but it will end probably by mid-2014, I've noticed that bond rates in Australia have started to go up. I do think the ultra-low rates that people can borrow at the moment have almost definitely bottomed out. And one of the things we're certainly saying to people is that if you've got some debt and you're able to fix it, that if you've got floating rate debt and you can fix it, now is a good time to do it. So speaking of interest rates and currencies, because of course the Australian dollar has lost more than 10% in the past few weeks, what is going on with Ben Bernanke and the US Federal Reserve? Well, it's pretty clear that the US economy is starting to improve. House prices are going up, unemployment has fallen, it's currently around 7.5%. Ben Bernanke has made it clear that when it gets towards 6.5%, that is another 1% of workers find jobs, he will get rid of QE or money printing as we call it. Now, over the past several years, the US Federal Reserve has been printing 85 billion new US dollars every month. Share markets love free money, it's kept the US dollar low, of course, and it's increased credit growth in America, and that is one of the reasons I think Ben Bernanke is to be congratulated for this, that the US economy is starting to improve. But of course, all good things must come to an end. And his official notification that quantitative easing cannot continue indefinitely in the future is the main reason why the share market chucked an absolute wobbly over the past few weeks. Indeed, from its peak of around 5,250 points, the ASX 200 index has lost 10% of its value. That is an official correction. And we see some excellent buying starting to emerge now. The US economy is improving. Yes, the Chinese economy has slowed a little bit, but it's still growing at around 7% per annum, and that's an excellent growth rate by anybody's standards. But of course, share markets are very short-term creatures, and hence the sell-off that we've seen recently. Australian resources companies, of course, are hostage to what's going on in China. The perception that Chinese growth is going down, at least in the short term, hasn't been kind to the share prices of BHP, Rio, and a whole slew of smaller mining companies. And the potential end of ultra-low interest rates has also seen the big banks sell off dramatically. Over the past 6 or 9 months, we've seen this chase for yields. Telstra, the banks and so forth have been bid up strongly. Combank, for example, and Westpac have hit record highs. They've all come back with the general market pullback of around 10%. And we see some excellent buying opportunities emerging here. The good news is for our exporters, the Australian dollar has fallen, so we've been looking actively at businesses that have some at least of their earnings coming from overseas. We recently have been buying in our main portfolio back into the banks. Australian and New Zealand banking group, ANZ to you and me, we've increased our weighting to that reasonably substantially, and also Westpac Banking Corporation, we've also bought a bit more of that on the pullback. Telstra, we're just going to keep a close eye on at the moment. Telstra's yield is still excellent, and the price having fallen from $5 down to below $4.60. In fact, right now it's around about $4.55. Telstra looks excellent value, but there is a question mark over the NBN asbestos problem, and as yet the politicians, Telstra and the NBN, have not decided who is going to bear the cost. It could be between $50 and $100 million of removing all this asbestos from its ducts. So we'll have to see, and hence that's the reason Telstra, while we still hold it, I think you've just got to just be a little bit wary of it at the moment until that particular issue is sorted out. And also I think the result of the federal election coming up, which is causing local consumers to keep their hands in their pockets. In our takeover target portfolio, we still haven't seen many new targets emerge. One of the things we've been looking for is a replacement for GrainCorp. That was an excellent takeover target that we picked. GrainCorp was one of the last of the big agricultural companies still listed on the Australian market after ABB Grain and AWB were taken over in the last few years. At the moment we're looking at Incitec Pivot, IPL. Again, it definitely benefits from a lower Australian dollar. We haven't decided to buy yet because we're going to continue to look at, but that's a agriculturally related stock. It makes fertilisers as well as explosives. In the property sector, we decided to reduce our holding of Australand. GPT was contemplating a bid for Australand. It's said at the moment they haven't reached agreement with the company. We still think GPT is interested, and the Australand share price had gone up a fair bit. And also one that we'd taken profits in was iiNet. All the second tier telcos that had a massive run in Australia, like Macquarie Telecommunications, along with Telstra. We took some profits in iiNet when it shot up. Now that it's dropped fairly sharply back from around $7.20 down to sort of the mid fives to high fives, we put some money back into that. Another infrastructure stock we've been looking at is Spark Infrastructure. Again, we really like the infrastructure space at the moment because it's not going to get unduly rattled by what happens in the economy. If you buy the right piece of infrastructure, you're buying long-term cash flows, and we do think companies like Spark will have a lot of appeal to big pension funds, maybe offshore ones, maybe Australian ones, but they're the sorts of natural owners of this sort of infrastructure. So overall, we see interest rates bottoming out. We think the Australian dollar could actually fall further. Some of our forecasts suggest it could go well back into the 80s. And again, that would be a good thing for Australia. It means that there's more unwinding of quantitative easing going on in America. In the short term, that could create share market wobbles. But in the long term, the good thing about QE being unwound in the US is that it means that the US economy is firmly back on track. And if it's back on track, that has to be good for the Australian economy, which is good, we hope, for the Australian stock market. Okay, thank you very much for your company. I look forward to doing it all again, same time next month.